Welcome. Just today we are going to discuss on accounting for receivables. Just today we discuss part 3. That means this one explain how companies recognize note receivables. Today's discussion on this topic. Explain how companies recognize note receivables. This one. And you know that the name of our chapter accounting for receivables. This is chapter 9. Accounting principle, Wegan, Kimmel, Kaisen. This is learning objective 3. Explain how companies recognize note receivables. So very interesting discussion today. Companies may grant credit in exchange for a promissory note. So just a promissory note. First we want to know what is promissory note. A promissory note is a written promise to pay a specified amount of money on demand or at a definite time. Okay, so here according to these definitions, a promissory notes may be used when individuals and companies lend or borrow money. Number one. Number second, this one, when amount of transaction and credit period exceed normal limits. Number three, in settlement of accounts receivable. The three matters related to promissory notes, and just we have used the promissory note for these three purposes. Moving on next, note receivables. Note receivables just payee to the payee. The promissory note is a note receivable. On the other hand, to the maker, the promissory note is a note payable. Just we will explain this matter here. This is payee. Payee means this one. Suppose Wilma Company, he is payee. That means he will receive the note or this just promissory note. And maker, the maker on behalf of this Calhoun Company, the treasurer, he is the maker of the company. That means actually these two matter is clear to everyone, I think, payee and maker. Now amount, just every note we need to show the amount here, $1000, and this is the place, that means date of note and place, Chicago, Illinois, May 1, 2017. This is the date of the note, and this is the 2 month after date. That means due date 2 months after date, and we promise to pay this amount. That means this amount, this 1000 we promise to pay, and to the order of Wilma Company pay, already we have said this, and $1000, this is the amount, and value of the receipt with annual interest 12%. This is the interest rate. I think everybody is clear. This note is this note. Now we are moving next. This is the note receivable, determining the maturity date. The note expressed in terms, months, and dates. And computing interest, how could we compute the interest? Face value of the note, annual interest rate, time in terms of 1 year, and interest. Just later on we will show this computation Okay, next, note receivable, computing interest. When counting days, omit the date of the note is issued but include the due date. Terms of notes, interest in computation. Suppose $730 12% and 120 days. So face value here, 730 rate 12% and time 120 days. So 360 days 1 year, and 120 by 360. After calculating or after computation, we are getting this amount. number second $1000 and 9% 6 month. So 6 by 12, this amount, this is the interest, and 2000 6% 1 year. Just after computing we are getting one by one, that means 1 year, so 120. So this is the computation of note receivable. Now recognizing note receivable. Here Calhoun Company wrote 1000 2 months 12% provisionary notes dated May 1 to settle an open account. Prepare entry would Wilma Company to make the receipt of the note. So he is receiving, that Wilma Company is receiving the note. He is the receiver, payee, that is note receivable debit and account receivable credit. Okay, I think everybody is clear. We are moving next. So do it recognizing note receivable. Gambit Stores accepts the Leonard Company $3,400 90-day 6% note dated May 10 in settlement of Leonard overdue account. What is the maturity date of the note? What is the interest payable at the maturity date? So here two matters here, or two question. Question number A. What is the maturity date of the note? The maturity date is August 8, computed as follows. Terms of note. This is May 30, 20, May 10. Here just May 10, May 10 to May 31st, so 21 days, and June 30 days, and July 31 days, so 82 days, and maturity date August 8, so 90 days. So 82 and 8 equal 90 days. I think everybody is clear. Second one, that means B. What is the interest payable? The maturity date. This is B. Interest payable at maturity date is 51. How could we calculate? Here face value, this figure, that means this figure. Rate of interest 6%. This is the 6%, and time 90 days. Time here, this is the 90 days. 90 days, that means 360. 90 days divided by 360, so interest will be 51. So thank you so much for participate.